I'm 94 years old. I have been buying stocks for 83 years. I started when I was 11. And right now, in 2026, I am selling. Not because I'm bearish on America, not because I think capitalism is dying, not because I've lost my nerve. I'm selling because the arithmetic has changed. And when the arithmetic changes, you change. Or you lose money. That's it. People think I'm a stock picker. That is nonsense. I am an arithmetic checker. I look at what something costs versus what it's worth, and I wait until the gap is so wide that even a fool can see it. Right now, there is no gap. There is a cliff. Here are the 5 simple rules that have guided every decision I've made for 8 decades. Rules that made me $150 billion. Rules that kept me from losing everything in crashes that destroyed geniuses. Rules I'm following right now as I sell billions in stocks while everyone else is buying. These rules are not complicated, but they are not easy. And if you ignore them because you think this time is different, you will learn the same lesson every generation learns. Arithmetic doesn't care about your feelings. Hit the like button if you're ready to understand why the greatest bull market in history is ending. I only share this with people who can handle the truth. Before we get into this, do me a favor. Drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country, just let me know. Here's why smart people are going to lose money in 2026. Most people think you make money in stocks by being smart, by picking the right companies, by timing the market perfectly. That is nonsense. You make money in stocks by buying things for less than they're worth. That's it. Not less than you think they're worth. Not less than some analyst says they're worth. Less than they're actually worth. Based on arithmetic, you can verify. Right now, stocks are selling for more than they're worth. A lot more. And when things sell for more than they're worth, one of 2 things happens. Either the worth catches up to the price, or the price falls to the worth. Guess which one happens more often? You don't need to be smart to understand this. You just need to be not stupid longer than everyone else. And right now, being not stupid means selling. I'll show you the 5 rules that have kept me rich through 14 recessions, 9 bear markets, and countless this time is different moments. The first rule is the one everyone ignores right before they lose everything. Let's start. Rule number 1. Price is what you pay. Value is what you get. This sounds obvious. It is not. The stock market right now is priced like we're going to have 15% earnings growth forever, 0 recessions, no wars, no inflation, and every company is going to compound like Apple in 2010. That is fantasy. That is not arithmetic. Let me show you what I mean. The S&P 500 is trading at 28 times earnings. 28 times. That means for every dollar of profit these companies make, you're paying $28. The historical average, 16 times earnings. The long-term fair value, 15 times. You're paying almost double what stocks are worth. And people are calling it the new normal. I've heard new normal before. I heard it in 1969 when the Nifty 50 were going to grow forever. They crashed 80%. I heard it in 1999 when the internet changed everything. The NASDAQ fell 78%. I heard it in 2007 when housing prices only go up. They cut in half. The new normal is always the same old arithmetic wearing different clothes. Here's why people pay 28 times earnings and think they're being smart. They confuse a good company with a good investment. Those are not the same thing. Apple is a great company, best business I've ever seen. But if you pay $1 trillion for something worth $500 billion, you lose money. It doesn't matter how good the company is. Let me tell you about Rick Gorin, smart man, brilliant investor, studied under Ben Graham with me, and Charlie Munger. Three of us started investing around the same time in the 1950s. Rick was impatient. He wanted to get rich faster, so he used margin, borrowed money to buy more stocks. When you use margin, a 10% gain becomes 20%, but a 10% loss becomes 20% too. The market crashed in 1973 to 1974, down 48%. Rick had to sell his stocks at the bottom to pay his margin calls. He lost almost everything. His stake in Berkshire Hathaway, had to sell it to me for pennies. Charlie and I didn't use margin. We waited. We were patient. The market came back. It always does. But Rick was already out. Today, Rick is comfortable, but not wealthy. Charlie died a billionaire. I'm worth $150 billion. Same starting point, same intelligence, same education under Ben Graham. Rick paid full price with borrowed money during a mania. Charlie and I waited for things to go on sale and paid cash. That's the only difference. And that difference compounded for 50 years into billions of dollars. Here's what people don't understand. The price you pay determines your return, not the quality of the company, not how much it grows, the price you pay. Let me make this simple. I'm going to show you two investors, same company, same stock, different price. Watch what happens. Investor A buys a stock for $100. The company earns $3.57 per share. That's 28 times earnings. What people are paying today. Over 10 years, earnings grow 7% per year. That's good growth. Better than most companies achieve. At the end of 10 years, earnings are $7.02 per share. Let's say the market is feeling generous and still values it at 20 times earnings, still overpriced, but less insane. Stock price, $140. Investor A made 40% over 10 years. That's 3.4% per year, less than inflation. Investor B waits. There's a recession. Everyone panics. The same stock falls to $60. Now it's trading at 16.8 times earnings, closer to fair value. Investor B buys. Same company, same earnings growth of 7% per year. At the end of 10 years, earnings are still $7.02 per share. Same 20 times earnings multiple. Stock price, $140. Investor B paid $60, sold at $140. Made 133% over 10 years. That's 8.8% per year. More than double Investor A's return. Same company, same growth rate, same time period, different discipline. The only difference was the price they paid. Investor A paid 28 times earnings because everyone was buying. Investor B paid 17 times earnings because everyone was selling. Here is the truth nobody wants to hear. You cannot get rich paying rich prices. You get rich paying poor prices and waiting. And right now there are no poor prices. There is only greed pretending to be optimism. Let me tell you about a woman I know. She worked for Coca-Cola in the 1980s. Middle management. Made $45,000 a year. Nothing special. The stock market crashed in 1987. Down 22% in one day. Everyone panicked. She bought $10,000 of Coca-Cola stock at $2.50 per share, adjusted for splits. It was trading at 11 times earnings. Cheap, but not crazy cheap. Just reasonable. She held it for 35 years, never sold a share. Reinvested dividends. Coca-Cola grew earnings at 10% per year. The multiple expanded from 11 to 25 as the market got more expensive. That $10,000 turned into $1.4 million. She retired at 60, sold half, lives on the dividends from the rest. She never made more than $80,000 a year in her life. She got rich because she paid a reasonable price and waited. That's it. No genius required, just discipline and arithmetic. Compare that to the people who bought tech stocks in 1999 at 100 times earnings because the internet changes everything. Most of those companies went to zero. The ones that survived took 15 years just to get back to break even. Same time period, same economy, different discipline. Price is what you pay. Value is what you get. If you pay more than something is worth, you lose money eventually. It doesn't matter how good the story is, how exciting the company is, how many people are buying it. Arithmetic is arithmetic. And right now the arithmetic says, sell. But selling isn't enough. You need to know what to do with the money. That's the second rule. Rule number 2, cash is not trash. It's ammunition. Right now, I'm sitting on $334 billion in cash. $334 billion. People think I'm senile. They say cash is trash. They say I'm missing out on gains. They say inflation is eating my purchasing power. Those people are idiots. Cash is not trash. Cash is what you use to buy things when they go on sale. And things always go on sale. Always. Without exception. In 83 years, I have never seen a period where good companies stayed expensive forever. The question is not, will there be a sale? The question is, will you have cash when the sale happens? Modern investors have been trained to think cash is stupid. They've been trained to be fully invested at all times. They think sitting on cash means you're missing out. Let me tell you what you're missing out on, the chance to lose everything. In 1968, I closed my investment partnership. We were managing $100 million. The stock market was expensive. Everything was overpriced. I couldn't find anything worth buying. So I gave everyone their money back. I shut down the partnership. I sat on cash. People thought I was crazy. The market kept going up for another year and a half. Then it crashed. 1969 to 1970, the market fell 36%. Then 1973 to 1974, it fell another 48% from the peak. Companies I couldn't buy at 20 times earnings in 1968 were available at 5 times earnings in 1974. I bought. Everyone else was broke. They had bought at the top, held through the crash, and had no cash to buy at the bottom. I had been sitting on cash for 6 years, doing nothing, looking stupid. Then I deployed. Washington Post at $5.63 per share, worth $50. Geco at $2 per share after almost going bankrupt, worth $20 within 3 years. Those investments made billions, made Berkshire Hathaway what it is today. And I only got them because I had cash when nobody else did. The people who called me stupid in 1968 for sitting on cash, they called me lucky in 1975 when I was getting rich. It wasn't luck. It was discipline. Let me tell you about long-term capital management. This was 1998. Hedge fund run by Nobel Prize winners. PhDs in mathematics, economics, physics. Two of the smartest people on Wall Street, Myron Scholes and Robert Merton, who literally won the Nobel Prize for their options pricing formula. They built a fund that used mathematical models to find tiny pricing inefficiencies in bonds. It worked. Made 40% per year for 4 years. Everyone thought they were geniuses. But they used leverage, not a little leverage. They controlled $1.25 trillion in positions with only $4.8 billion in capital. That's 25 to 1 leverage. For every dollar they had, they borrowed 25 more. This strategy was low risk because the pricing gaps were tiny and the positions were hedged. The math said they could only lose a little bit of money on any single trade. They were right about the math. They were wrong about reality. Russia defaulted on its debt in August 1998. The bond markets froze. Prices went crazy. Their hedges stopped working because nobody was buying anything. Liquidity disappeared. In 4 months, they lost $4.6 billion, almost all of their capital. The leverage meant small moves created massive losses. They had to be bailed out by 14 banks putting up $3.6 billion to prevent a complete financial system collapse. Nobel Prize winners. Perfect math. Total disaster. You know what saved Berkshire during that crisis? Cash. We had $15 billion sitting in Treasury bills earning 5%. When everyone else was scrambling for liquidity, we were buying. We made money in 1998, while geniuses lost everything. Here's what people don't understand. Leverage amplifies everything. It amplifies gains when you're right. It amplifies losses when you're wrong. And it eliminates your ability to wait. When you're leveraged, you have to sell when the market says sell. When you have cash, you can buy when the market is stupid. That's the difference between being a forced seller and a willing buyer. Cash gives you options. Debt gives you obligations. Choose options. Let me show you why cash is ammunition, not trash. Scenario A. You're 100% invested in stocks. Market crashes 50%. Your $1 million becomes $500,000. Market recovers over 5 years. You're back to $1 million. You made 0% over 5 years. Scenario B. You're 60% invested in stocks, 40% in cash. Market crashes 50%. Your $600,000 in stocks becomes $300,000. Your $400,000 in cash is still $400,000. Total $700,000, down 30%, not 50%. But here's the magic. You take that $400,000 in cash and buy stocks at 50% off. Now, you own $300,000 of your original stocks plus $400,000 of new stocks bought at half price. When the market recovers over 5 years, your $300,000 of original stocks gets back to $600,000. Your $400,000 of new stocks bought at half price becomes $800,000. Total, $1.4 million. Same crash, same recovery, same time period, different discipline. The person who was fully invested made 0%. The person with cash made 40%. And the person with cash actually lost less money on the way down because they had less exposed to the crash. That is why cash is ammunition. It protects you in crashes and allows you to profit from them. Right now, I'm sitting on $334 billion in cash because there is nothing worth buying at these prices. When the sale comes, and it will come, I'll have $334 billion to spend while everyone else is trying to figure out where their money went. In March 2020, COVID hit. The market crashed 34% in 5 weeks. Fastest crash in history. Everyone panicked. We had $128 billion in cash. We bought airlines, banks, energy companies. Everything was on sale. We deployed $50 billion in 6 weeks. Those investments are up 60 to 80% today. We made $30 to $40 billion in profit because we had cash when nobody else did. The people who were fully invested in February 2020, they had no cash to buy in March. They had to watch the sale happen without being able to participate. Some of them panic sold at the bottom and locked in losses. We made billions. They lost. Same crash, different discipline. Charlie used to say, the big money is not in the buying and selling, but in the waiting. The waiting requires cash. If you don't have cash, you can't wait. You have to act. And action at the wrong time is expensive. Cash is ammunition for when things go on sale. And things always go on sale. The question is whether you'll have the ammunition to take advantage of it. Right now, things are not on sale. They're overpriced. So I'm sitting on cash, waiting, looking stupid to people who are fully invested and making 20% per year. I'll look smart when the crash comes, and I have $334 billion to spend. They'll look broke. But cash alone won't save you. You can destroy all your cash in one day if you violate the third rule. Rule number 3, debt kills, slowly, then suddenly. Debt is the destroyer of wealth. Not sometimes, always. Every single financial disaster in history, personal, corporate, national, starts with too much debt. The reason is simple. Debt makes you a forced seller. When you owe money, you don't get to decide when to sell. The lender decides. And the lender always decides at the worst possible time. That's not bad luck. That's arithmetic. People think debt is a tool. They think good debt exists. They think if you can borrow at 5% and invest at 10%, you should borrow as much as possible. Those people eventually lose everything. Here's what they don't understand. The 10% return is uncertain. The 5% payment is certain. When the uncertain part doesn't work out, you still owe the certain part. And if you can't pay, you lose everything. I have never borrowed money to invest. Never. Not once in 83 years. Berkshire Hathaway has never had significant debt. We could borrow $500 billion tomorrow if we wanted. Banks would line up to lend to us. We don't borrow because we don't have to. And we don't have to because we don't borrow. That's the secret. Let me tell you about a surgeon I know. I won't use his real name, but this story is true. He made $800,000 a year, lived in Los Angeles, age 48. Everyone thought he was rich. He had a $3.5 million house with a $2.8 million mortgage. He had a $150,000 Mercedes, leased. He had a vacation home in Aspen, mortgaged. He sent 3 kids to private school at $50,000 per kid. He belonged to a country club, $25,000 per year. His monthly expenses, $35,000. His monthly income after taxes, $40,000. He was saving $5,000 per month. Sounds good, right? Wrong. At 50, he developed arthritis in his hands. Couldn't operate anymore. His income dropped from $800,000 to $200,000. His disability insurance, his expenses, still $35,000 per month. His $40,000 monthly income became $12,000. His $35,000 expenses stayed the same. He was losing $23,000 per month. He had $200,000 in savings. That lasted 8 months. Then he started selling things. Sold the vacation home at a loss because he was desperate. Sold his stock portfolio at the worst time, 2022, when the market was down 25%. Pulled the kids from private school. Sold the Mercedes. Downgraded the main house. At age 52, he had nothing. Everything gone. 20 years of earning $800,000 per year. Zero wealth. He's 55 now. Works as a medical consultant, making $150,000. Lives in a rented apartment. Will work until he dies because he has no retirement savings. What killed him? Debt. Every single expense was leveraged, the house, the cars, the lifestyle. When his income dropped, the debt didn't care. The mortgage didn't say, "Oh, you have arthritis, pay us later." The country club didn't say, "We'll cut your dues in half." The debt wanted its money. And when he couldn't pay, it took everything. Let me tell you about another doctor. This one made $300,000 per year, half what the surgeon made, lived in the same city. She bought a $600,000 house, paid cash, no mortgage. She drove a Honda Civic, owned it. She sent her kids to public school. She had no country club membership, no vacation home, no fancy lifestyle. Her monthly expenses, $8,000. Her monthly income after taxes, $15,000. She saved $7,000 per month. More than the surgeon, even though she made $500,000 less per year. She invested that $7,000 every month in index funds for 25 years. Never sold. Reinvested dividends. Averaged 9% per year. She retired at 60 with $6.2 million. No debt. Owns her house. Lives on $250,000 per year from her investments. Will never run out of money. Same city. Same profession. Different discipline. The surgeon looked rich. The doctor looked middle class. The surgeon is broke. The doctor is wealthy. That's what debt does. It lets you look rich while going broke. The arithmetic. Let me show you the math on debt versus no debt. Person A buys a $500,000 house with a $400,000 mortgage at 6%. Monthly payment, $2,398. Over 30 years, total payments, $863,352. Interest paid, $463,352. Person B waits 5 years, saves money, buys a $500,000 house with cash, no mortgage, no interest. Total cost, $500,000. Difference, $363,352. Now, let's add opportunity cost. Person A pays $2,398 per month for 30 years. Person B pays $0 per month and invests that $2,398 at 8% per year. After 30 years, Person B has $3,389,926 in their investment account, plus they own the house free and clear. Person A has nothing except a house they finally own after 30 years of payments. Same house, same 30 years, different discipline. But it gets worse. Person A had a mortgage. When the recession came and they lost their job, they couldn't pay the mortgage. The bank foreclosed. They lost the house and their credit. They ended up renting. Person B owned their house outright. When the recession came and they lost their job, they still had a place to live. No payments, no foreclosure. They survived. That is why debt kills. It doesn't just cost you money, it costs you options. It costs you security. It costs you the ability to wait out bad times. Debt turns you into a forced seller. When you have debt, you have to pay no matter what. Market crashes. Pay anyway. Lose your job. Pay anyway. Get sick. Pay anyway. And when you can't pay, you lose everything. Not just the thing you borrowed money to buy, everything. I'm selling stocks in 2026 because too many people are using debt to buy stocks. Margin debt is at record highs. Private equity is leveraged 5 to 1. Companies are borrowing to buy back shares at all-time highs. When the crash comes, and it will come, all that debt will force selling, and forced selling creates panics, and panics create crashes. I won't be part of that. I'll be sitting on $334 billion in cash with zero debt, waiting to buy what they're forced to sell. But you need more than just cash and no debt. You need the fourth rule. Rule number 4. Never interrupt compounding unnecessarily. Einstein supposedly called compound interest the 8th wonder of the world. I don't know if he actually said that, but it's true anyway. Compounding is how you get rich. Not stock picking, not timing the market, not finding the next Amazon. Compounding. But compounding only works if you don't interrupt it, and people interrupt it constantly. The problem with compounding is that it feels slow at first. You invest $10,000, it grows to $11,000 in a year. You made $1,000. That doesn't feel life-changing, so people get impatient. They sell and try something else. They chase the hot stock. They try to time the market. They interrupt the compounding. What they don't understand is that compounding is not linear. It's exponential. The gains in year 20 dwarf the gains in year 1. But you only get to year 20 if you don't interrupt it. Let me show you what I mean. I bought Coca-Cola in 1988. Paid $1.3 billion for 6.2% of the company. People thought I was crazy. Coke was already huge. How much could it grow? I'm still holding it. Never sold a share. That investment is worth $25 billion today. I've collected another $8 billion in dividends over 37 years. Total gain, $32 billion on a $1.3 billion investment. That's a 24 times return, 9.1% per year, every year, for 37 years. Was Coke the best stock in the market during that time? No. Lots of stocks did better for shorter periods. But I wasn't looking for the best stock. I was looking for a good stock that I could hold forever. Because forever is where the magic happens. Let me tell you about a man who interrupted compounding. I'll call him Jim. Real story. Jim started investing in 1980. He was 25 years old. He put $5,000 per year into the S&P 500 every year, like clockwork. He did this for 10 years. By 1990, he had invested $50,000. The market had done well. His account was worth $150,000. Then he got smart. He decided he could do better than the index. He started trading. He would hold a stock for a few months, sell, buy something else. He was looking for the next big winner. From 1990 to 2020, he continued putting in $5,000 per year. Another $150,000 invested. He was actively managing his portfolio, buying and selling, trying to beat the market. In 2020, his account was worth $890,000. Not bad, right? Here's the problem. His friend Susan did something different. Susan also started in 1980. She also put in $5,000 per year. But Susan never traded. She bought the S&P 500 and held it. Did nothing for 40 years. In 2020, Susan's account was worth $1.4 million. Same contributions, same time period. Susan made $510,000 more than Jim. Why? Jim interrupted. Compounding. Every time he sold a stock, he stopped the compounding on that stock. Every time he traded, he paid taxes and fees. Every time he tried to be smart, he was actually being stupid. Susan let it compound. 40 years of uninterrupted compounding. That's the difference. Jim spent 40 years working hard to make less money than Susan, who did nothing. That is the cost of interrupting compounding. Let me show you the math on interrupted compounding. Investor A puts $10,000 in the market at age 25, leaves it alone for 40 years, earns 10% per year, never sells, never trades, just lets it compound. At age 65, $452,593. Investor B puts $10,000 in the market at age 25, trades every year, averages 10% per year on his trades, same as Investor A, but pays 2% per year in taxes and trading costs because he's selling and rebuying. His effective return, 8% per year after taxes and costs. At age 65, $217,245. Same starting amount, same market returns, different behavior. Investor A has more than double what Investor B has. That 2% difference, the cost of trading, the cost of taxes, the cost of being active, cut his wealth in half over 40 years. Now let's add another variable. What if Investor B wasn't just paying 2% in costs, but was also trying to time the market and got out at the wrong times? Studies show that the average investor who tries to time the market earns about 3 to 4% less per year than the market itself. Not because they're stupid, because timing is impossible. If Investor B earned 6% per year instead of 10% because of bad timing and trading costs, his $10,000 becomes $102,857 at age 65. Investor A, who did nothing, $452,593. Investor B, who tried to be smart, $102,857. The cost of interrupting compounding, $349,736. Over 70% of his potential wealth destroyed by activity. The success example. I bought See's Candies in 1972 for $25 million. People thought I overpaid. It was only making $5 million per year in pre-tax profit. That's expensive. But See's had pricing power. Every year we raised prices a little. Every year people kept buying. Every year the profit grew. From 1972 to 2025, See's has generated over $2.5 billion in cumulative pre-tax profits from a $25 million investment. We took those profits and invested them in other businesses. Those businesses generated more profits. We reinvested those. On and on. That $25 million investment has created more than $50 billion in value when you account for all the compounding over 53 years. I never sold See's, never tried to trade it, never interrupted the compounding, just held it and let it work. Charlie used to say that our job was to find a great business and then do nothing. The doing nothing was the hard part. Compounding works miracles if you don't interrupt it. But it requires patience. It requires doing nothing when everyone else is doing something. It requires being boring when everyone else is being exciting. Right now, I'm selling stocks not because I want to interrupt compounding, but because stocks are so overpriced that the compounding has stopped. When you pay 28 times earnings for companies growing at 7%, your compound return will be 3 to 4% per year. That's not compounding. That's treading water. I'm selling to preserve capital so I can buy back in when the compounding actually works again. When stocks are cheap enough that the math makes sense. Because the goal is not to be invested. The goal is to compound wealth. And sometimes compounding wealth requires selling. But the hardest rule, the one that destroys more investors than all the others, is the fifth rule. Rule number 5. The crowd is always wrong at extremes. The crowd is right in the middle. The crowd is wrong at the top and wrong at the bottom, always, without exception. When everyone is buying and prices are high, that's the top. When everyone is selling and prices are low, that's the bottom. Right now, everyone is buying. That's why I'm selling. The problem is that it feels wrong to go against the crowd. When everyone is making money and you're sitting in cash, you feel stupid. When everyone is excited about stocks and you're selling, you feel like you're missing out. That feeling, that social pressure, destroys more wealth than bad stock picks ever could. People are social animals. We're wired to follow the herd. It kept us alive for 200,000 years. But in investing, it kills you because the herd runs off cliffs. And when the herd runs off a cliff, you don't want to be in the middle of the herd. Everyone was buying tech stocks. Everyone. If you weren't buying tech stocks, people looked at you like you were senile. The internet was going to change everything. Any company with .com in its name was going to make you rich. Traditional valuation metrics didn't matter anymore. We were in a new era. I didn't buy tech stocks. Berkshire was up 0.5% in 1999, while the NASDAQ was up 86%. People called me a dinosaur, said I didn't understand the new economy, said I was too old. Fortune magazine ran a story, "Has Warren Buffett lost it?" I was sitting on $20 billion in cash, doing nothing, looking stupid while everyone else was getting rich. Then March 2000 happened. The tech bubble popped. The NASDAQ fell 78% over the next 3 years. Companies that were worth $100 billion went to zero. Pets.com, Webvan, eToys, gone. People who looked like geniuses in 1999 were broke in 2002. They lost everything chasing the crowd over the cliff. I didn't lose anything. I sat in cash, waited for the panic, then bought good companies at reasonable prices. From 2000 to 2005, Berkshire was up 60%, while the market was still recovering. The crowd was wrong at the top. The crowd was wrong at the bottom. I was right because I ignored the crowd. Financial crisis. Banks were failing. The stock market was crashing. Everyone was selling everything. Pure panic. September 2008, I wrote an op-ed in the New York Times, "Buy American, I Am." People thought I was crazy. The world was ending. Lehman Brothers had just collapsed. AIG was getting bailed out. How could I be buying? I was buying because everyone else was selling. When there's blood in the streets, you buy. Even if it's your own blood. I bought $5 billion of Goldman Sachs preferred stock, $3 billion of General Electric, billions more in other companies. Everyone else was running for the exits. I was walking in. Those investments made 50 to 60% over the next few years. Goldman alone made us $3.7 billion in profit. We bought when the crowd was panicking and sold when the crowd was comfortable again. The crowd is always wrong at extremes. 2008 was an extreme. Everyone selling. That was the bottom. 2021 was an extreme. Everyone buying. That was the top. The market is still coming down from that top. And I'm selling because the crowd is still buying things that are overpriced. Let me show you the math on crowd behavior. The market goes up 80% of the time. Small moves, steady gains. During these times, the crowd is roughly right. Buy and hold works. Being invested works. But 20% of the time, the market has extreme moves, crashes down 40 to 50%, or manias up 100% plus. During these extremes, the crowd is always wrong. If you follow the crowd during the 80% of normal times, you make money. If you follow the crowd during the 20% of extreme times, you lose money. A lot of money. The problem is that the losses during the extremes are bigger than the gains during normal times. Example: you invest $100,000. Market goes up 50% over 8 years. You have $150,000. You follow the crowd. Everyone is excited. You stay invested. Market crashes 50%. You have $75,000. You lost $25,000 even though you made money most of the time, because you followed the crowd at the extreme. What if you had sold when the crowd was buying? Sold at $150,000, sat in cash during the crash, bought back in when the market was down 50%. You'd have $150,000 worth of stocks bought at half price. When the market recovers, you have $300,000. Same cycle, different behavior. The person who followed the crowd lost money. The person who went against the crowd doubled their money. That's why the crowd is always wrong at extremes. The extremes are where fortunes are made and lost. And the crowd always does the wrong thing. Be fearful when others are greedy. Be greedy when others are fearful. I've said that for 50 years. People nod their heads. Then they do the opposite. When everyone is greedy, like now, they get greedy too. When everyone is fearful, they get fearful too. That is why most people never get rich. They follow the crowd. And the crowd is always wrong when it matters most. Right now, the crowd is greedy. Record amounts of money are flowing into stocks. Retail investors are buying at the highest valuations in history. Everyone thinks they're going to get rich. I'm selling, not because I'm smarter than them, because I've seen this movie before. I know how it ends. I learned these rules from Benjamin Graham. Let me tell you about him. Ben Graham was my professor at Columbia in 1950 to 51. He was 56 years old, had lived through the 1929 crash, lost almost everything, rebuilt his fortune by following strict rules based on arithmetic, not emotion. He taught me one principle that changed my life. Price is what you pay. Value is what you get. That sounds simple. It is simple, but it's not easy. Ben would analyze companies by the hundreds. He'd look for ones selling for less than they were worth based on assets, earnings, cash flow. Hard numbers, no stories, no excitement, just arithmetic. He'd buy when they were cheap, sell when they were fair. He didn't try to time the market. He didn't try to predict the economy. He just waited for prices to get stupid, then he bought. My mother told me a story about Ben Graham. During the 1973 to 74 crash, when everyone was panicking and selling everything, Ben was buying. Someone asked him, "How do you have the courage to buy when everyone else is selling?" Ben said, "I'm not courageous. I'm just doing arithmetic." These companies were worth $50 per share 3 months ago. Nothing about the companies has changed. They're selling for $20 today. That's not a crisis. That's a sale. My mother remembered that story because it was so obvious. Once you heard it, the price changed. The value didn't. That's all that happened. But everyone else was looking at the price and panicking. Ben was looking at the value and buying. That's the difference between investors and speculators. Investors look at value. Speculators look at price. Over a lifetime, investors get rich. Speculators go broke. Let me make this simple. Here are the 5 rules. Price is what you pay. Value is what you get. If you pay more than something is worth, you lose money. Right now, stocks are expensive. Don't pay expensive prices just because everyone else is. Cash is ammunition, not trash. When you have cash, you can buy when things go on sale. When you're fully invested, you're a spectator. I'm sitting on $334 billion in cash waiting for the sale. Debt kills, slowly, then suddenly. Debt turns you into a forced seller. Forced sellers always lose. Never borrow money to invest. Never let lifestyle debt trap you. Never interrupt compounding unnecessarily. The magic is in the waiting. When you trade, when you sell. When you try to be smart, you interrupt compounding. Most of the time, doing nothing is the smartest thing you can do. The crowd is always wrong at extremes. Be fearful when others are greedy. Right now, everyone is greedy. That's why I'm fearful. That's why I'm selling. These are not complicated rules. A child could understand them, but almost nobody follows them because simple and easy are not the same thing. Here is your challenge. Look at what you own. Look at what you paid for it. Look at what it's worth based on arithmetic. Real earnings, real cash flow, real assets. Not hope, not stories. Arithmetic. If you're paying 28 times earnings for companies growing at 7%, you're going to earn 3 to 4% per year for the next decade. That's below inflation. You're losing money slowly. If you're using debt to invest, you're setting yourself up for disaster. Not maybe, definitely. When the crash comes, and it will come, debt will force you to sell at the worst time. If you're trying to time the market, trade frequently, chase hot stocks, you're interrupting compounding. You're working hard to make less money than people who do nothing. Do not wait. Do not make excuses. Look at the arithmetic today. Because every day you delay is a day you're paying too much for things that aren't worth it. I am 94 years old. I might have 2 years left, maybe less. I am telling you this because I won't be here much longer to tell you. And I don't want you to learn this lesson the hard way, the way every generation learns it when they think this time is different. This time is not different. The arithmetic never changes. Stock prices go up, stock prices go down. But value, real value based on what a company actually earns and actually does, that changes slowly. Right now, prices are way above value. That gap will close. It always does. Either prices fall to value or you wait 10 to 15 years for value to catch up to prices while earning nothing. I'm not waiting. I'm selling. I'm sitting on cash. And when the gap widens the other way, when prices fall way below value because everyone is panicking, I'll buy. And I'll make billions while everyone else is trying to figure out what happened. The formula is right here. Buy things for less than they're worth. Hold cash when things are expensive. Use no debt. Let compounding work. Ignore the crowd. That is it. Follow those rules and you will get rich slowly and surely. Ignore them and you will stay poor quickly and painfully. Your choice. Now, if you want more brutal honesty about investing, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth. And the truth is that I'm selling in 2026 because the arithmetic says to sell. Whether you listen or not is up to you.